Richard, welcome to the show today.
Appreciate you having me here, Michael.
Yeah, it's been a little minute here, and I want to know, and I think the previous podcast we had, we really talked about kind of how you got into the family office space, and if someone is new to this, definitely listen to that. But it's been several years, Richard. What I want to know, I mean, you've really done this now for many years, and you've worked with hundreds of family offices and ultra wealthy individuals, and I'm just curious, like, what's something that surprised you when you first got into that world, and maybe something that still surprises you today?
Yeah, I think one thing that surprised me is that you think of somebody who is worth hundreds of millions of dollars and you just assume they must be very smart at structuring deals, at coming up with a strategy with their money. They must be very evolved in their thinking. But the reality is maybe they are just very smart with merchant account processing, and that's how they grew it to $1 billion. Or they're very smart at fintech. They've never had a family office before. So when I first got into it, that just kind of shocked me that like, even, I started this when I was 26 years old, 18 years ago. And by age 29 or 30, I knew more about much of the family office space than people worth 400 million, $800 million. And that kind of blew my mind, right? So that's one thing. And then over time, one thing that's been driven in that's surprising is that the context, the trust, the relationship matters more than the deal. So
Mm.
the ultra wealthy families, they invest based on trust, conviction, relationship. They're not investing based on what you promised the IRR would be, right? Do they want it to look like a good deal and a good place for their money? Of course they do. But they'd much rather invest with someone they trust versus someone who promises more.
It's interesting you mentioned that about that family office don't seem to know how to invest money. And they're two separate things. Just because you know how to grow a company doesn't mean you know how to invest with it. In
Right.
my case, I didn't actually grow a company. I had a software IPO, so I kind of won the lottery. I was in the right place at the right time with this web methods company and went public in 2000. So put a bunch of money in my pocket. And I
Right.
and I was dealing with something similar, like, and I kind of do feel like I got lucky a little bit, right? I mean, yes, I did put myself in the right position. I worked hard, but nevertheless, I didn't build a company myself. But I still had this
Right.
problem. Now I had this windfall, and the only thing I did was to give it to my financial advisor at Morgan Stanley, right? And so they're sending me
Right.
these statements. Market goes up, market goes down. I noticed that they were getting their fees no matter what happening in the market. I was like, daggone it, that's weird. They make money either way. It's
Right.
like when I was in my pizza franchise, the franchisor made money on gross revenue, not actual profit. So I'm like, daggone, I'm in the wrong business here. But
Yeah.
you're so right. Just because you make money one way doesn't mean that you can make it another way. That's interesting. Saying, well, so what you're having to do is you have to educate what you think are very sophisticated investors, and they're not. You're kind of
Right.
almost starting over from scratch.
Right, right. Some of them are sophisticated. They've figured more things out than I have the last 18 years. But when they first have a liquidity event, they're almost never sophisticated. Even if their money was created in finance, they're not sophisticated in the area of family offices typically right out of the box. And I think that, if you plug into somebody else's system that they've designed, they're going to design it so that they get $200 every time you pass go, and they're going to charge you rent every time you roll the dice and go around their game board. And you're like a pinball inside their pinball machine. If you create your own family office, you're designing your own game, how you're going to track the rules, how you're going to progress. And that's the whole point of creating your own family office.
Exactly right. Now you mentioned something about trust. Like you said that family offices care more about trust than the actual like returns.
Yeah.
And what does that really mean in practice, especially for the person who's trying to maybe break into the family office game? Like, how
Sure.
do you build trust? What does that look like when someone's trying to get in? And maybe also
Yeah.
talk about what level that typically people are breaking into family office, right? Because if you've never done a deal before, chances that you're going to break into the family office is probably kind of slim. So what does that look like from someone I'm going to call starting from scratch? So define what is scratch in your world, and then what does that relationship building look like?
Sure, sure. Yeah. So one thing is that there's a full spectrum of types of ultra wealthy families, right? You could start with, if you're intimidated about going to big families, you could start with 10, 20, 30, $50 million net worth families. There are some that have formalized family offices at 30, 50, $70 million, or a virtual family office at 10, 20, $30 million. So that's important to know. One thing that'll drive these investors away sometimes is high pressure selling tactics when they don't even know you. They're like, even if they're in the market to buy a Rolex watch, someone who randomly comes up to them at the airport and says, "You want to buy this Rolex?" They're like, I wouldn't buy from you. I want to go to a registered dealer to know it's authentic. So amateurs overpromise to family offices and they promise the moon and there's no room to over deliver. Where the more seasoned professionals, they add value first, they listen, they build a relationship, they're genuine, they're authentic, and they make sure from the very beginning they do something that's highly unique so you don't sound like everybody else. And if you're good at building relationships and you do something that no one else is doing and you're saying things that no one else can say because what you do is so unique, then you're going to be light years ahead of everyone else who's pitching a deal that sounds like everyone else's and focusing on the returns. And they don't care at all about the returns until they know who's behind the deal.
So that makes it difficult for pitching something that's been around for decades, which is multifamily, for example, or self-storage, or really anything like that.
It does make it more difficult. It raises the bar on what someone's seen 10,000 times before. But maybe you only do multifamily in one county of San Diego, and you're so laser focused, you only do that. Or maybe you only do multifamily rescue deals or deals where you can assume debt that's 3.5% or lower, or only do multifamily deals where you can get seller financing or some sort of pref equity structure. But it has to be something that is really unique if the space is more commoditized. Like there are 75,000 AI companies out there now. If you want to raise capital for number 75,001, it better sound like really unique and either have real revenue or really hit someone between the eyes. And you have an AI platform for plumbers and you just raise capital from the owners of plumbing companies. Like you don't have to teach them plumbing. They haven't heard of anyone else's AI platform for plumbers. So you could sell to that demographic in the family offices within that sub niche. And now you have something unique out of 75,000 AI companies.
Interesting. So if you're in some place that sounds more like a commodity, make sure it sounds sufficiently different so that it piques their interest. Also, by the way, probably lowers risk if it's so specific. If you got something in a particular county or a particular structure of some sort, and then so you need a unique product. I get that. And then how do you go about building that relationship? So you have to have a message that's going to be picked up. But how do you get
Sure.
into that? Where do you hang out? How do you get close to these people? How do you get them to take you seriously?
Sure. I think about Peter Thiel's concentric circles theory of like starting in a small niche, dominating that, and then growing and growing the niche more and more as you dominate a niche so small, no one else really cares about it. And the three different types of trust you typically need to build is trust in the leadership, the person, trust in the industry or understanding the industry, and then is the investor local to the deal? So I'd always start with people that are local to you, who made their money in the industry or could walk the manufacturing plant floor or walk through your offices and meet the AI engineer in person, whatever it is. The more that you can meet in person, be local to them, and they're from your industry, the faster they'll move up the trust curve to investing with you. And so, one real trick to getting this all done is to go to investors, try to add value first, build the relationship, et cetera, but make sure that you're going to investors that can open doors for you, get you distribution, grow your revenue, play defense for you. They'd be so valuable. You'd be honored to have them be on your board and go to them first. So if you're raising capital for a dry cleaner that you want to acquire, go to somebody that built 10 dry cleaners and sold it, go to them, offer them special terms and a sweetheart valuation, and say, would love your help. I'd love just 10 minutes of your time, once a quarter, once every 2 months. We'll give you a sweetheart valuation terms and we'd just love to get some of your advice. Or if you'd like to take a quarter or half of the deal, we'll make it too good for you to refuse on the terms. And now you have got a brain trust on the deal, and the next investor might come in, even if they don't know the dry cleaning business. But ideally, you go to all people that are local to you or know the dry cleaning business.
That's an interesting idea, Richard, of approaching people to be on your board. That's not normally typically done. Now these
Right.
people would if let's say could they would is there a possibility where someone would go on someone's board without investing? Like, hey, I'm going to give you 5, 10, 15% of the GP, but I want you on my board. Like, is that a way to leg into that potentially? Or are they typically going to want to invest?
I use it as not a formal board membership because that comes with D&O insurance and liability. So it's important that you don't scare investors off by saying be a board member, but instead be an advisor or a consultant, or we just like to have you be a strategic investor on the cap table. That's how we approach it. Because otherwise people are saying like, well, what are you going to pay me for being your board member? And it turns the conversation into a negative instead of a positive. Instead, There's a saying in the capital raising space that says, if you ask for advice, you might get capital. If you ask for capital, you might get advice. So you could start with literally just getting them their advice on a deal you're looking at and just say, hey, I really expect your expertise. I know you have a ton of experience here. You mind taking a quick look at this? And you can always softly mention, hey, if you end up being interested, we'll make you deal terms that are way better than the average investor. We show this to you because I understand if you got involved, you could make this thing go straight up. But you mind taking a quick look? And then they know the industry so well. Hopefully, they've done a good job structuring that deal. And they're like, oh, you're getting seller financing at 5% flat, and it's much better than bank terms, et cetera. And then they like the deal, then they might take a big chunk of the deal. And I find that if you can accomplish that, everything else takes off from there.
That's amazing. So what I'm hearing is you have to maybe be a little more generous to attract that kind of person. And if you're going
Right.
to give up a disproportionate amount of your deal, but now you gain this kind of person in your sphere, and that's
Yeah.
you're in the game. One person is in your deal. Now you can use it as a gateway to potentially get other investors. And so now you're in. That's very interesting. Yeah, very interesting. Now,
Yeah, or they might take the whole deal. We've had it before
huh.
where one billionaire we work with will just fund the whole deal and take it all down themselves. And we had one person who was offered $30 million to fund all of their deals for their next 5 deals. I was in the real estate space by chance, and they looked at the term sheet. They said, "Oh, well, we think these terms are kind of aggressive. We've never given away that much before." And I said, "Well, have you ever been offered more than $10 million before by a family office?" They said, "Oh, no." And I said, "Well, go and get other term sheets of people that put 10 million plus to work, and then come back and tell us if it looks aggressive. Because anyone who gives you all the money you need for your next 5 deals, it's going to be more aggressive terms than like a little golf club high net worth investor puts in 25K, obviously, right? Like someone like you knows that, obviously. But sometimes people are like, oh, I thought it'd be on the same terms as someone that put in 100K. It's like, well, of course it wouldn't. So you have to just know that up front.
It's interesting. So someone brings all this money to the table. Now, do they want to actually control and operate the deal, or let's separate? Do they want to operate the deal? I mean, certainly if you're putting in $10-20 million, they probably want at a minimum step-in rights if something goes wrong. But
Yeah.
do they want to operate? In other words, would they hire you to operate the deal? How would they structure the deal? Let's say you do that and you say, I've got this deal, I'm ready to raise money, I can't raise all the money. And then they come
Right.
in and say, I'll do the whole thing, but here's what I want. And you're like, well, we don't normally do that. What would that thing be that you've seen happen before?
Yeah, we've had several versions of that happen. One is sometimes they just need to have 51% or 50.1% ownership, and that is required. We've also seen it where they just have step-in rights, like you said. So I'm glad you mentioned that up front. And like, if it goes wrong, you have this much time to cure it. If it still goes wrong and we don't like what you're doing, then we're going to step in and make sure we don't lose our money, because it's more our money than yours at the end of the day. Many times, someone will go to a family that could write a $10 million plus check, and they'll hear that the family only does their own deals. They're like, oh, okay, I guess I can't work with them. But if you really show the family the quality of what you can source or have done, they may be open to a joint venture. They might just not want to be open to being one of your robotic LP investors in your deal. And so I think that's really important to know, that like the wealthiest people in the world are just super founders and super entrepreneurs. And Family Office Club is our business, and that's why the family office industry now is bigger than all of private equity and all of venture capital combined. There's $14 trillion in the family office space. Now, most people know about private equity or venture capital. They don't even know about family offices. And so when you negotiate with them, you just have to think, what would a savvy entrepreneur do? What would I do if I was in their shoes? And try to respect that at some level and be open-minded, because they may love pref equity or debt or gross revenue royalties or equity. And some will demand equity control, but would be okay with step-in rights, is what I found.
Now, you mentioned your family office club is the association that you created, where you basically bring up these family offices together. But if someone wants to raise capital, how does one start meeting these high net worth individuals?
Sure. Number of ways. One, in every major city, there are ultra wealthy families. Some will call themselves a family office, some will not. That doesn't matter as much as just understanding how the ultra wealthy think and act and what they prefer. One way to start is we have a YouTube channel called Centimillionaire Strategies, and we have 1,300 videos and interviews with not only billionaires and Mike Tyson and centimillionaires, et cetera, but also family offices, of course, on there. But we also have a mini series called the $100 Million Rainmaker mini series, and it's 17 videos of exactly how to get started raising capital from family offices, and that's one of our most popular mini series out there. The other way is that I've got a free book at capitalraising.com on 5 steps to raise capital, and then at familyoffices.com. We show our event schedule. We're hosting 30 events next year. We're doing 20 some this year. And the reason I bring up those variety of things is that these days there's so many pitches coming at business owners, and they don't know what's real and what's not. And if they operate like me, you want to like profit off of an idea or just see that it's genuine sometimes before moving forward with something. So yeah, they could buy a membership in Family Office Club, but honestly, like some people aren't there yet. They're a startup. They don't have money for a membership, or they're listening to this from India, and like they're not going to come to the US to our events. And all that's totally fine. We've found that in the family office industry, the more you give away and create good karma and not burn bridges, then just like you doing this podcast, then like the better things go, right? So we always try to be as generous as we can with insights, because there's no shortage of insights, and people that don't share anything, have a mindset maybe of scarcity around that.
You bring up a good point. I mean, the barrier of entry is financial to some degree. Your events aren't free. You have to travel there. A lot of these events are not free either. They're kind of expensive because they're attracting high net worth individuals. They're going to be in nicer places. And so at what point does it make sense for an operator to start attending these? What size or what kind of things are they doing?
Sure. I would say that between $1 and $3 million in revenue, you should start attending these, because understanding how family offices think is just going to allow you, even if you don't raise $1 of capital and you fund everything organically, seeing how super founders think, how they structure deals, how they make acquisitions, how big they think, what they say no to, how they guard their time, how they present themselves, how they articulate their ideas. It's just going to grow your brain and get you excited about business. So if you're doing 1 to 3 million in revenue, or if you're a well-funded, well-capitalized startup, then I would do it. I think if you've raised more than 3 to 5 million or $5 to $10 million and you want to get to the next level, you may have to build relationships and work with small to medium-sized ultra-wealthy families before you land a big one. But if your deal flow is amazing, someone might structure a JV with you, or make you part of the deal just by sourcing the deal, and you don't have to do anything else, and they'll run with it. So I would say those are kind of the lower level ways. We have a full spectrum. We have people that are publicly traded and have $1 billion in AUM, and then we have some that manage 100 million, and we have some that are relatively early stage entrepreneurs. And the one case study I'd love to share is just that at our last event, I didn't know he was going to be speaking. He said he struggled to raise $5 million. Then he read the free book on capital raising that we provide. And by talking about education and his industry, instead of pitching all the time, he attracted more investors, and he grew to 55 million in assets now pretty quickly. In his last deal, he raised the 5 million in equity he needed in 72 hours. And that was just last month. And that's in this really bad economic environment where like you can source great deals, but it is harder to raise capital than it was 2 years ago.
Right. And he's having some success raising from family offices, I assume.
Right. Yep.
Yeah, that's a good point. What are when let's say someone were to attend one of your events, what are some of like the biggest red flags that immediately disqualify someone from being taken seriously? Like I'm sure you've seen all kinds of people. You're like, oh, good Lord, don't do these 3 things.
Yeah, like one of them is someone rushing around, literally trying to shake everyone's hand, anxious, sweaty, stressed out, high pressure, or literally saying, "Do you have money? Are you an investor? Are you an investor?" Because people are going to feel that pressure, and they'll be like, "Oh no, I think the investors are over there," And that's one thing. The other thing is being too quick to judge. People that are very wealthy many times are relatively humble. They're not wearing a 3-piece suit and a cummerbund. They don't have a title of "I'm the CIO of my own family office." If you ask them what they do, you might say, "Oh, I'm in the car wash business." And like they don't have any need to beat their chest. People are beating down their door every day to sell them something. They don't need more attention. And so it could be that they just sold their 19 car washes for $100 million. It could be that, they are from a family that's been in the car wash business for 100 years. Who knows, right? And so sometimes the most low-key families are the wealthiest, and some percentage of the 6-inch Rolex watch with the Lamborghini people are just highly in debt and have nothing behind them, right? So I think that is a common misconception at our events, that they see it as, who am I going to raise capital from right now? And they misjudge based on clothing or appearance or how much somebody beats their chest on how big they are. and then they end up spending time maybe with the wrong leads and maybe move past people that were the most valuable people in the room.
That's fair. I mean, if someone were to like they've raised 3 to 5 million and want to get to the next level, and they start attending your events, how long do you think it'll reasonably take for someone to invest with them? I mean, because it sounds like you don't want to
Yeah.
go in there and be aggressive. It's going to take a while. And what are
Yeah.
you seeing? Is that 1, 2, multiple year, 5 years? Like, what are you seeing that's reasonable?
So the most successful people get about 5 different types of return on their investment by attending. So I'll talk about that in a second. But also, the most successful are okay with needing to be patient for medium term results. And that could be developing a relationship for 3 to 5, 9 months. Some people come to one event and they raise capital and they find seed capital, they find a partner, an investor, et cetera. Some come to 6 events and then they find a big investor. One, never heard of a family office, had struggled to raise his first 4 million. He came to our events, found out what a family office was, raised the next 8 million, and bought a company for 12 million. And he just sold it for $100 million about a year and a half ago. We have many cases where people came and then got a $40 million check or a $4 million check or 400,000. But what's really important is that, let's say you came and you never met a single investor that you closed at our events over a year or two or even 3. You can learn strategies for growing your platform and raising capital that help you the next day when you're at Starbucks and you meet an investor that had nothing to do with our club, but the strategy helps you raise the capital. You can get better at negotiating. You can structure your deals creatively. You can get like the family office mindset dialed in and how big they think and how to converse with them and add value to them first. And so by thinking about it as I can source investors, but I'm hanging out with super founders, it's like, all right, now you can structure deals, negotiate, position. All of these things make you a more powerful business person. And plugging into artificial intelligence and capital is like electricity for your platform. And figuring out how to do that is the most important thing. And it's the difference between somebody giving you a fish and teaching you how to fish. And you're literally getting taught how to fish from the fish when you're hearing from them on stage. So I think that's the big thing that most people miss. They come with a short-term mindset and they don't even see those other ROIs.
Yeah, that's a really good point. I think if you go to an event like that with the agenda of raising money, you're not going to raise any money at all. And I think
Yeah, potentially.
that's
Yeah.
really important. And like you said, these are I mean ultra net worth people, right? How are they thinking? Why are they thinking like that? I think just soaking that up is going to be valuable enough. Now, I'm curious. So real estate obviously has always been a good portion of ultra net worth portfolio allocation. Now, with
Right.
regard, and multifamily has been at the core of that as well. But with what's happening over the last 2.5 years, where does real estate fit into that spectrum right now? Multifamily specifically, but other asset classes, whatever they're, what is happening? Where are these ultra net worth individuals investing their real estate right now, or how are they treating their real estate holdings?
Yeah. Yeah, the squeeze has been that basically with interest rates going up, uh, you can now earn money risk free, 4% and change essentially. So the threshold for cash flow they expect from something that actually has risk, treasuries have some risk but very little, goes up, right? So people expect more, and so what's happened is that there's a lot of hard money lending and pref equity deals that do get done, but investors can have relatively sleep at night, hard collateral behind an investment, and even after fees, et cetera, make 10, 11, 12, even 13% sometimes on like a hard money lending or a debt deal, or expect to earn around that amount. So that changes the dynamic. And now people say, oh, well, I can get a promised 15% return, or I can be secured by real estate and get this credit return. So credit's just exploding in popularity, and it has been the last year and a half. And people keep saying, I'm almost getting an equity-like return with the security of debt. So you're pretty aware of that. Some of the deals that do get done in multifamily are, again, the rescue capital deals or some sort of recapitalization event, which at least makes it so the old investors don't get wiped out, but the terms are much better for the new investor. We see that happening. A lot of people had floating rate deals and they weren't locked in, so they're damaged by that. So in terms of where investors are putting their money besides credit, I think that cash flowing, profitable businesses have been around for 10, 15, 20 plus years, are more popular. Reoccurring revenue SaaS businesses have been popular for a decade, and the valuations of those are crazy. If you have anything over 1 million in revenue, the recurring revenue multiple you get on that is really extreme. And people who are savvy about that will try to find early stage recurring revenue SaaS companies and grow those. But sourcing those is very challenging for the average family office. I think in a world of potential destabilization of currencies, et cetera, there's a lot more talk into a couple of things. Cryptocurrency has come up more often in the last 2 years. So a lot of families have a lot of Bitcoin, and then secondarily, Ethereum or other stablecoin related coins, like maybe some XRP, et cetera. I personally do as well, just for strategic reasons. I don't spend much time on it, but I do as well. And then also, they look at all these waves of wealth being created over time, right? There's like sports betting got approved in a few states and then many states. And then cannabis got approved in a few and then many. And like psychedelics is on the path. You look at crypto, we had kids in 2011, 12, 13 that got laughed off stage at our events. They're probably all billionaires now, and all of us should have put money in back then, obviously. So I think those are some big areas that are important. And I think that the more wealth is created around these new areas, the more that we basically have to ask ourselves, how do you look forward instead of backwards at where wealth is created, and what happens if US dollar does falter or inflation goes crazy, right? Is it gold? Is it robotics? Is it quantum computing? How do we get ahead of the next wave that's coming? Because nobody that I know can see the waves beyond robotics. AI is already crashing on us now. Robotics, quantum computing. There's not many waves people are predicting beyond that with great confidence that are massive waves. But if you can, then like Peter Thiel says, it's the closest you can get to predicting the future, being confident about what nobody else can see yet. So it's a long answer, I know, but I see a combination of all of that happening.
All right, a couple of ways I want to take it. So real estate, it sounds like to me, has been relegated a little bit more to equity, almost, or pref equity of some sort, instead of actually holding it. Now, don't you lose the tax benefits? In other words, what are the ultra net worth doing for the tax benefits that you get for real estate if you're just doing debt?
Right. Yeah, no, great point. I think with Trump's bill going through, it reignited interest among some for tax planning, of course, with cost segregation and bonus depreciation. I think that many were sad to see the solar credits being winded down like end of this year. I think that was not a decision that I would support, and that hurts. I think oil and gas, is an area that some investors go into for the tax efficiency and the tax credits, et cetera. And there are still equity deals getting done in real estate. I just think that 2 or 3 years ago, you could snap your fingers the right way a few times and it raised some capital for a lot of things, right? And it was almost like there was a capital raising bubble. Like everybody's a sponsor, syndicate everything. Like let's get another deal done, and everyone bought. And now investors have been sobered up, and they have a little bit of a hangover from that capital raising bubble because some of those promises didn't come true. And in fact, instead of getting a 2.x on their money, they lost all their money. And so because of that, it's harder to pitch the equity deal. You have to truly be a laser focused platform that they really trust and know, and they understand with high conviction what your value add process is and how you're going to force appreciation, or you're dead in the water. And if you can't say in one sentence why your equity or debt deal is excellent, different, unique, clear, you're dead. And at our events, we ask people to submit their one-liner, and we read it on stage to our investors. Most people don't submit one, even though it's free exposure. And the ones who do, it's almost always 2 sentences, not a one-liner, clunky, sounds like everybody else, generic. It's horrible. And these are like the people who volunteered them, and they get horrible reviews. And it's costs nothing. You don't need to hire a big PR firm to write your one-liner. Like if you can't say what you do in a sentence that gets people to lean forward, you shouldn't buy a plane ticket to go to a conference or have that be your mission. Like figure
What's a good one-liner, Richard?
So I remember one of our clients, I think his name is Ahmed, said, over the last 13 years, we've closed 479 hard money lending deals with 116 investors. Okay, I know you do hard money lending. You've done 400 plus deals. You have 100 investors that trust you. There's social proof. There's like good positioning there. Like it's credible, and you can't wake up in your mother-in-law's basement and say that same thing unless you're a complete fraud tomorrow if you haven't done what Ahmed has done, right? So, if you look at the homepage of familyoffices.com, you'll see our one-liner. And if you look at our join page, you'll see that we have a 1-minute video, which is just as important. Nobody wants to look at your 40-page pitch deck until they see a 1-minute video from the founder and they read one sentence that blows their mind. And if you can't do those two things, then like why even have a pitch deck? Because nobody's going to want to open
Yeah.
it.
Yeah, I love it. Now, a couple things I heard here is that, I mean, I heard you AI, obviously AI, people trying to get exposure to AI, crypto on the one hand, but I did hear you saying cash flowing businesses, SaaS businesses specifically because of recurring revenue. Do you see like there's kind of demand growing from family office to get into cash flowing business? And if so, like which kind? All kinds? What kind? I mean, is that true that there's a growing interest in that space? Or maybe not.
Yeah, I think there is. I think there's a growing interest. I think one of the tricks is if you are a family office and you sell your business and you want to not hire a big private bank and you want to trade stocks and you don't want to hire, you want to be cheap and not hire a wealth manager, but you made your money in auto dealerships. How are you going to manage a stock trader underneath you? You can get the wool pull over your head so quickly, right? You won't even know if they're cheating you or not with their prime brokerage fees, kickbacks, et cetera. The same goes for family offices looking at people buying businesses. The trick is, how do you know the operator knows this space cold, right? Are they only buying pool service companies? Are they only buying HVAC or plumbing or electrical? I do hear HVAC, plumbing, talked about probably the most out of people buying businesses. Not that that's bad, but is that becoming kind of the multifamily of private equity? Are these mom and pop HVAC, plumbing? I don't know. It doesn't mean it's bad. The best players in the biggest markets, there's more deal flow to gather up, and then you'll have a bigger exit multiple because there's behemoth gorillas that will pay a very nice private equity multiple to you. So it's not bad when a space has been consolidated. It actually means you might get the highest payout if you can survive in that jungle. But I like personally niches that are a niche deeper and either are laser focused on one region or city within a popular niche, or an area that people just don't think about but have a moat around it. Like it could be a porta potty rental service. It could be like just something strange like that. That like, who dreams of being in the porta potty business when they grow up, right? Or like, so different ideas like that do have stability, years track record, a moat, relationships, and then how do you preserve relationships and sales as leadership changes and you buy it? Those are the questions that come up often when we see those in our club.
Interesting. So what are you most excited about, Richard?
I think most excited about is the area of artificial intelligence. We have a platform called Investor Superintelligence, and we've developed 40 like GPT accelerators basically to help with due diligence. We've had over 1,000 due diligence reports ran through that. We have ones that crunch investor data and help you find investors right in your backyard or that are interested in your area, and other ones that just take the collective intelligence of all the investors that have spoken on stage at our 300 events, 985 billionaire talks that we've transcribed as well. And we have due diligence and other best practices, and basically using a like swarm intelligence agent approach so that when you present to it what you're trying to navigate as a founder, it analyzes it from all these perspectives and is giving you that feedback and having it debate and vote and give you a well-rounded, clear path forward. And we use those tools constantly internally, and I probably spend more time than anything else on the artificial intelligence tool set.
Yeah, that's pretty cool. So just on that note, how do you see AI kind of affecting what you're doing and your family offices?
Yeah, I think that right now we're helping put together a family office for a $150 million net worth family. And we're having the very discussion of like, how do we make this an AI first, like AI native family office? Because already family offices love to hire people that have worn 2 or 3 hats. Like, oh, you used to be a CPA and you can also be like my in-house attorney, legal counsel, and you can help me look at deals. Great. And now they can pay that person more, they'll be more loyal, and they can have a smaller, nimble team, right? But now with AI, I think it just makes family office space even more nimble and ability to be lean and then compensate the few people you do hire even better than before. So that's one way. The other area is that now you can load 10 pitch decks up into like our Dewey due diligence advisor tool and it will rank them and analyze them in dozens of different ways. And you can take the top three, have it write 7 due diligence questions for all three, and send those emails out and see what people say to that. And it took you 30 seconds to do that versus having to read the pitch decks, come up with a smart question. So it's massively faster for conducting thorough due diligence. And the flip side of that is if you're raising capital, then you need to have like a 30 question due diligence questionnaire of like every smart, sophisticated investor should be asking these questions. Here's the questions, and here's answers to all 30 of those. So you're well informed. I'm being transparent. Here's the risks. Here's the good, the bad, the ugly, et cetera. Then that will build trust faster. So I think those are some of the major ways. And at our last event, somebody said that the world has never moved this fast before. So some people might be like, whoa, what is going on? Ever since COVID, it feels like the world is on like turbo speed, and it almost feels like a movie sometimes with the headlines that come out. But at the same time, even though the world has never moved this fast, it'll never move this slow again. So you have to buckle up and be quicker, be more agile, learn faster, and use the technology to really understand it.
So you mentioned some of the websites in the book before, but let's go ahead and remind our listeners where people can find out more about you and the stuff you've got going on.
Yeah, sure. Best place for Family Office Club, just go to familyoffices.com. So it's familyoffices.com. And we have our event schedule there on the homepage. On the join tab, we have the membership options. We've got a free book and my interview with Tony Robbins, and you'll find interview links on there as well to our billionaires.com website, where I've interviewed 46 billionaires. We've got all the interviews there for free for you to check out as well to get to know us a bit. And yeah, appreciate you having me on here.